Hello and welcome to another edition of Arrow Insights. And one topic we thought that would be of interest to our viewers is common investment mistakes or common investment portfolio mistakes. Ryan, you review prospective client portfolios regularly, and you see a number of issues within the client portfolios, and you thought you'd share some of those with us today.
Thanks, Seats. Yeah, so today I've brought in 5 different investment mistakes I commonly see in prospective client portfolios. As I get their asset allocation and undertake a review of what's going on. I think to start, one of the biggest common mistakes you see is a lack of overarching investment strategy. I think it's very hard to implement an effective program if you're not documenting and laying out, what are the objectives for the portfolio? What are you actually trying to achieve? And how will that be achieved within the portfolio? Ensuring that the asset allocation, matches those goals. Sometimes you'll review a portfolio and it might just be a complete mess, and, they might be looking to fund their lifestyle, but they're 100% allocated to illiquid assets or things like that. So having a documented investment strategy is very important. It allows you to put in place goals and objectives, and also benchmark a portfolio over time.
So it's kind of advice that you could apply to any part of your life. If you don't plan or have a strategy, you can be lost and not have a pathway to move forward. So what else do you say?
I think another big one particularly probably applies more to retirees and investors, more so in the pension phase or where they're relying on the portfolio for income, is not provisioning enough for income requirements. So, if a client was needing to withdraw, $100,000 a year, having some form of, nest egg or provision within the portfolio to actually fund that. What can happen if you don't do that is, markets may go through a severe drawdown, and you may not have the liquidity or the defensive asset exposure within the portfolio to fund your living expenses, which as a result, you may be selling risk assets at an inopportune time, which can really impact that portfolio into the longer term.
In Australia, do you often see that with regards to investment properties as well, where investors are getting to that time in their life where they need to start drawing down their assets, and perhaps the rental income of that investment property doesn't meet their needs?
Yeah, correct. So within superannuation, you may have a mandated withdrawal requirement that might be 3, 4, 5% per annum. With an investment property in the portfolio, if that's a very concentrated holding, it's obviously a liquid, so you can't redeem that very quickly. Or you can't redeem a portion of it as well. Mm-hmm. So it can tie investors up, and which it can get particularly messy.
Can't sell off a bedroom.
Can't sell off a bedroom, no.
What else do you see?
I think another mistake on the flip side, if you go from pension accounts more so to accumulation accounts, often you'll find these might be people middle-aged, very busy, might have young kids, senior employees. You can often find that there's a lack of care around their investment portfolio, and they're probably not attending to it enough. And what can happen in that instance is that portfolios can accumulate cash as dividends or distributions are received within a portfolio. The cash can really climb, and it can only take 1, 2, 3 years for that balance of cash within the portfolio to get quite substantial, and that'll impact the overall return of the portfolio if you're holding cash throughout an environment where markets have been particularly strong.
And we all know the power of compounding growth, and if you're missing out on that, especially earlier in your life, can make quite a material difference later on in your life. What else are you seeing?
Another thing that you see, probably not as common, but it does happen from time to time, is single security concentration. Someone might have owned a position in their portfolio for a very long time, or potentially they were employee of a specific company, and they have a very concentrated position to call it an individual name, whether that's CSL or CBA. It may take up 30-40% of their portfolio or even more. It does present a major risk to investors. It doesn't take much for sentiment to change very quickly around a particular business. There may be an issue with a director's personal life or some negative sentiment around that business specifically to cause it to sell off quite aggressively, which can have a material impact on the overall portfolio. That's something that's quite easy to address just through diversification and just managing the sizing of positions within a portfolio, just to ensure that one single company doesn't drive too much of the overall return profile.
And I can envision in a circumstance like that where, let's say, a single position has grown to be substantial in the client's portfolio, there could also be an emotional attachment to that, be it it's something they earned through their employment, or perhaps it's grown so much that they have enjoyed its growth so far that it might be something they have some resistance to diversifying away from.
Yeah, correct. And I think that's advisors play a good role in that because we're viewing it from a third-party perspective. We don't have the emotional attachment, so there's not that bias there. So we can provide a distance opinion on what they could potentially do with that position.
You mentioned you had 5 investment mistakes. What's the 5th?
Yeah, the last one. So this one's very common. See it quite often. And that's just sort of limited asset class diversification. For prospective clients, it's very common when you review their portfolios to maybe just see a basket of Australian shares, an investment property, and probably nothing else around that. It's very simple to improve a portfolio in that scenario, adding an asset class such as even international equities or something as simple as private equity. I think by adding those exposures, you immediately improve the diversification qualities of the portfolio, and in some instances, you might also enhance the return potential of that portfolio as well.
So you've gone through here 5 different problems or issues that you commonly see in investment portfolios. What about solutions or ways to avoid these pitfalls?
Yeah, sure. So I think that's where the advice process is quite valuable. For our clients here at Arrow, they're having their portfolios reviewed at least once a year at a minimum, and it does allow us to assess whether there's been changes to any personal to a client's personal situation, and whether that in turn needs to have a change to their investment strategy. In addition to that as well, consulting an advisor also allows someone to provide a third-party opinion on what it is you're doing within your investment portfolio, and we may be able to come up with solutions or opinions on and around how we believe that portfolio could be enhanced.
Appreciate your expertise and sharing your insights today. I hope you at home or wherever you are as a viewer, you found that insightful. Thank you for joining us, and we'll see you in the next one.